As Christian just said, my name is Christopher Wright, and I'm an analyst for Coeli Global. Some of you may remember my boss, Andreas Brock, from last year. He unfortunately couldn't make it here today, so he sent me to present a UK idea. So we'll be talking about Mortgage Advice Bureau, which is in the, excuse me, in the UK mortgage industry. So about who Coeli Global are, we're an employee-owned asset manager based out of Stockholm. We have roughly about €1 billion in assets. Andreas and Henrik are our PMs. And as you can see, our performance has been pretty good in our large cap Coeli Global Select Fund. We've just recently opened a global small cap fund. And what the idea that we'll be presenting today will be from our global small cap fund. So, the company in question today is called Mortgage Advice Bureau. And I think that the easiest way to think about this is a kind of a back of the envelope. What is this business? Why is it interesting? And why would I be interested in buying shares in this today? So the easiest way to think about this is Mortgage Advice Bureau is a good business. It's kind of run into an issue because of the UK mini budget. So the government's kind of unfortunately impacted it. And that's obviously kind of led to a bit of an issue and the share price has come back. But the good thing is that things are now starting to turn around. So we're going to sort of address these things in roughly sort of broadly 3 parts. Sorry, excuse me, I'm just going to adjust this because I'm a bit taller. Can't really see. There we go. So, the easiest way to think about this is, I know that we've probably got a lot of Europeans here, so I'm going to kind of have to frame things for you in the way that it works in the UK. So, I recently got a mortgage in Sweden. I went straight to the bank. The bank provided me a mortgage, and then my girlfriend and I bought an apartment. In the UK, during the GFC, there were a bunch of really bad mortgages written. A lot of customers ran into really bad issues. And that was sort of really negative for them. So in 2014, the UK FCA, which is the regulator, brought out what's called MMR. I won't go into that today because I know that it's 8:30 in the morning and it's a bit early. But it's basically regulation that says that you need to legally be advised if you get a mortgage. So instead of me to bank, it goes me, advisor. Advisor works for me. Advisor shows me all of the mortgages within the market. They're not tied to a bank. They're paid a commission by the bank. But then they say, all right, this mortgage is best for you based on all of these KYC criteria, Mr. Wright. This is the best one that you should have. Effectively, this is one we're going to go for. And then they write the mortgage through, in this case, Midas Pro, which will be Mortgage Advice Bureau's software product. So I want you to kind of think me, mortgage intermediary, and then bank. So Mortgage Advice Bureau is the UK's largest independent mortgage intermediary. It works, it's still founder-led. And the founder still owns roughly 18% of shares, so he's very involved day to day, very sort of hard-driving guy. And it works as a master franchisor. So effectively the mortgage advisors are franchisees. Mortgage Advice Bureau, the sort of the rough deal that you kind of get is that we'll provide you our Midas Pro software platform, which allows you to work your business, and we'll give you a lead source. And then obviously you'll be out actually sort of talking to the clients, and we roughly take about 27% of your revenue and you get the other sort of 73%. So it's kind of a 3/4, 1/4 kind of way of thinking about it. And roughly this is kind of actually a people business. So if you want to think, okay, one mortgage advisor roughly equates to about £100,000 of revenue and about £12,000 of EBIT for MAB, if you kind of think about it that way. So the good thing about it is that I think one thing that's really important to understand is when you look at the accounts of this company, you'll kind of see that the gross margin appears to be about 27%. That's because of the fact that MAB, as they get all of the actual commissions from the bank, they have to recognize all of that revenue. So all of the cost of goods sold is actually just being paid straight out to the actual franchisees. They do keep some, but we won't go into that technicality. They do hold some back rather. But if you sort of think about that, actually gross profit is truly actually what sort of the actual MAB revenue is. So I want you to sort of go to the notes of the accounts and dig a little bit deeper, and you'll actually see that this business basically runs at 100% gross margin. The positive thing is that MAB's actually gained market share every half, pretty much since listing, and even before that, since inception. And roughly the MAB advisors are about 2 times more profitable on the EBIT level than the competitors. So this is kind of the 100-pound gorilla in the room, which is kind of taking market share from everyone else. This is where, if you're an advisor and you want to make a lot of money, the most amount of money you can make is from MAB. And bear in mind that they're giving you the lead sources as well. That's quite important to understand. As we can kind of see on that graph on the right-hand side, they've been growing advisors by about 20% per year. So good business, taking market share, and also kind of growing their advisors, which is positive. Oh, sorry, I'll use the clicker. There we go. So I think people kind of think, oh, Mab, this is a housing stock. I think the most important thing that I can leave you with today, before you go to sleep or if you want to switch off, the key thing to understand with this business is that it's actually not really that. There's more nuance to it than that. So firstly, 40% of the mortgages that are written are actually what's called remortgages. So in the UK, you can typically get a 2, 3, or 5-year fixed mortgage. And every time that comes up for renewal, you have to rewrite the mortgage, you get the same fee. So I kind of want you to think, okay, 60% of this business is people, buying a house, 40% of the guys that have already written to before, and they're kind of, they've just come up for renewal, if you sort of think about it that way. Now, the other sort of, important thing to sort of understand about this business is that this isn't just kind of advisors sitting there waiting for people to actually come in the door. And I'll tell you a small story about this just to sort of help you sort of size this. And when I was doing Scuttlebutt and talked to one of their largest franchisees, which is a listed company called Belvoir, Dorian, who's the CEO, his wife is actually a mortgage advice bureau advisor. And I said, I just don't understand how their revenue per advisor can be so incredibly stable. The market's moving around a lot. I thought there would be at least some sort of correlation. And he said, look, the way that this business works is that effectively a lot of the time these people will be on the phone or out actually driving business. So for my wife, if she actually wants to pay her, like her private school fees, if she wants to pay her mortgage, if she wants to sort of actually earn her salary, she needs to get on the phone and actually generate business. She's getting leads. She can go and work her book and actually generate a lot of business. So this isn't just sort of wait for the customer to come to me. You can actively go out and actually sort of like raise the advisor utilization to a very high level. So that's kind of the key thing to really understand here is when we sort of start to dig into the actual mortgage written per advisor and things like that, it's actually incredibly stable. So we sort of see these lines here in terms of around the housing market moving around a lot. You'll see in these graphs here that actually the revenue per advisor is super stable around £100,000. In 2013 and 2014, that was when the MMR came in. So that's kind of the regulatory capture which has pushed the business towards MAB. So just kind of bear in mind that. But this business is actually incredibly stable at the per advisor level. And I think a lot of people sort of missed that. I think we just missed the slide here. Sorry, I'm going to come back for one. Right, sorry. This is actually the financials that we'll see down here on the right-hand side. So if we just consider the gross profit basically being their revenue, that's grown greater than 20% per year. These guys have got like a 40% free cash margin. So if you kind of just read their accounts, have a quick look at actually what goes on in their cash flow statement, it's just free cash flow. This is not a capital intensive business at all, as you can see. They're running an EBITDA margin of basically greater than 50%. So this is a super, super, super cash generative business growing at 20% per year. And you can see that red line, obviously, of the mortgages actually in the market moving around a lot, and the notional mortgage written per advisor being very stable around 10.5 million to 11.5 million per advisor per year. Right, so I think one thing that's quite important to just sort of quickly touch on, I'm not going to bore you with this, is the UK mortgage market. So as we said before, you have to be advised, so the regulation's favourable, so the government's actually asking you to go to someone like MAB, which is really important. We talked about how it's kind of partially repeat in nature. There's all these remortgages coming up. One thing to understand, and I'm sure some of you guys from, at least me from Stockholm, I know that property prices have kind of gone a bit bananas. In the UK, prior to COVID, a lot of the property prices had actually been down. They've been in a bear market for depending on what kind of region you'd been in. So we haven't seen these kind of insane kind of levels. LTV rates on the actual properties are really good. Only basically 30% of mortgages written are above an LTV of 75%. So there's a whole lot of people who are basically cash buyers of property. So the whole actual market itself is actually, quite stable, as we can kind of see. And I think one of the important things to understand is that this data that we got here is actually off the government, but a lot of the time you'll read in the newspapers, the Guardian will say, obviously terrible headlines around how the mortgage market's going and how things are really bad. If you actually look at this graph here, I mean, ignoring 2008 and the crazy time before that, it's actually super stable. That's a boring graph that doesn't really write many headlines, but it's the truth. It's sort of the uncomfortable truth that many people don't want to understand, is that the UK mortgage market in terms of new and remo was actually really stable. So, what happened? Why can we buy this good business at a good price? As I'm sure some of you may understand if you're from the UK, there was this sort of fiasco last September with the UK mini budget. The government basically issued a budget which they just simply couldn't pay for, and there was a huge liquidity crisis. The Bank of England had to step in. Basically what happened with banks is they just withdrew 50% of mortgage products. They just said, this is kind of too hot for us, it's a bit of a shock. We kind of can't deal with this basically. We need to come and actually just simply remove the products and wait for things to calm down. So this is a market shock. Prior to this, Mortgage Advice Bureau, their financial year is the calendar year. And then the first half of the year was kind of an all-time high year. So things have been going good for them. And then they ran into the shock where basically all of these actual mortgages got withdrawn. So a big issue. However, now what's happened is obviously, as I'm sure many of you know, Rishi Sunak's come in, Jeremy Hunt's come in as the new Prime Minister and the Chancellor of the Exchequer, and they've reversed the whole thing. Things have calmed down again. So crazy plan, reversed. Right, so we sort of talked about how that would affect the mortgage market. That's obviously been negative. The one important thing to understand is that it's actually priced off swaps, not off the Bank of England rate. So people think, Bank of England's raising rates, my mortgage is going up. Actually, mortgages have been coming down for the last, probably, let's call it 6 months, because they're priced off these swaps that are priced off that gilt level there. So in September, mortgages were probably about 6%. Now you're getting them under 4%. So that's quite an important thing to understand, is it's not just BOE raised rates, mortgage goes up. Actually, that shock meant that the mortgage rate was actually super high and now coming down. So that's quite an important thing to understand there. As we can kind of see, Mortgage Advice Bureau, they were not immune to that. Even though they're a very stable business, if the banks just remove 50% of the products, there's nothing you can really do about that. And their volumes during September, October, and November basically were down around 50%. The important thing to understand this here is that they've extrapolated forward minus 50% down for this year. So that minus 50%, is that reasonable? Let's look back over time and say, has that actually ever happened before? Let's sort of size that risk and think about that just from a statistical basis. So if we look at the worst kind of year in the GFC, I think that was 2010, and that was roughly about 914,000 transactions. The implied transactions for this year, when actually mortgage rates are coming down, household rates have got all-time high savings, there's structural reasons to move house. That would imply that it's around 670,000 transactions. So if you think that's call it 30% lower than the worst year of the GFC, think about that kind of just for a second. Is this year going to be 30% worse than the GFC when banks were being nationalised and they were not offering loans? Think about what the odds of that are. Have a quick touch on here on valuation. So, I'm not sure if many of you guys know this before, but Mortgage Advice Bureau, with those wonderful financials, was actually an incredibly profitable stock for many people for a long time. It was a 10-bagger from 2014 listing to 2021. Traded at 35 times earnings, had wonderful financials, paid out all of that free cash flow as cash, has no reinvestment need, no marginal cost to serve. So as you can imagine, it was expensive. And it went from £14.50 down to £4.50 as everyone kind of just saw Armageddon. Because let's remember, the government did nearly go bankrupt, so that's not ideal. And obviously there's quite a lot of contagion. People are worried about things. So trades today about £6. So it's kind of come back up a little bit, but way off the highs. And let's just kind of quickly size the valuation for kind of assuming the different activity levels. So previously their forecast for FY23 were 49 million. Let's have a quick look in terms of, if it was down 50%, they'd be doing roughly about £25 million. You'd be buying it at roughly about 18 times PE or 16 times EV free cash flow. If they just return to basically the same productivity level in FY that they previously had been, you're looking at about, call it, 12 times PE. And bear in mind this business has grown 20% a year. We're excluding all that growth. Let's just kind of ignore that for now. So, is the market actually coming back? I won't try and get too technical with this because this is where it gets slightly boring, but with one thing, there's a thing called conveyancing delay. If I instruct a mortgage, I want to go buy a house, it actually only sort of technically transacts 3 to 4 months later once the lawyers have kind of done it. So basically any sort of transactions that you see in December were probably written in August. So all of these headlines that you see that kind of come out that are quite self-serving, as you sort of see in the top there, these are all mortgages that were written basically just at the end of summer. Now, the important thing to understand is we can actually get live time data from Rightmove and Zoopla, the two platforms, about what's actually going on with the actual mortgage transactions. Here's Peter Brooks-Johnson from Rightmove from the 3rd of March on their conference call. If you're interested in this, you should definitely read this conference call transcript. This will tell you everything you need to know. They're basically saying, he's talking about the fact that the transactions are actually lagged. He kind of mentions that at the top. He's saying on their metrics that actually basically things have been down roughly about sort of 10 to 12%. So things have actually come back from that minus 50, and you'll see that in that chart there. So is it coming back? Yes, that's kind of what we see on the left-hand side there. It's a little bit small, but I'm going to try and point it out here. But that purple line right there, it's actually tracking bang in line with 2019. So everyone's saying it's going to be down 50. Well, we know live from the platform data, which covers 100% of the market, that it's either 10 to 12 or 0. They actually measure the data slightly differently depending on new build, but that's kind of irrelevant for now. But it's early days, but things are actually rebounding quite quickly because we know that the market's actually pretty stable. And this is just a final sort of point that we want to sort of touch on here, just sort of seeing the swap rates at the top right-hand side there and mortgage rates coming down. And this is actually another sort of quite important point to talk about. So remember how we said about how the mortgages were going to be, say, 670,000 implied, something like that? Here's Peter basically saying that the 3 deaths, so the 3 Ds, debt, divorce, and what was the other one? Debt, death, and divorce, usually give you roughly about 850,000 transactions minimum per year. So there's just a recurring number of housing transactions that happen in the UK per year. And actually, in reality, most people think that it'll probably be more like 1.2 to 1.3. So, in final summary, we've got a good business. People basically just got shocked because of the government and what happened. Wasn't really MAB's fault. There's nothing they could really do about it. And now people haven't really seen the actual transaction data come through due to conveyancing delay. But if we look at the leading indicators, we know that actually things are coming back quite strongly. Any questions? Yeah.
Thank you, Chris. One second, Stephen. I give you the mic.
Hi, thank you. That's a great presentation. I'm wondering in UK from an affordability perspective, because of the higher cost of living and everything else, as far as the cost of mortgages and what you're talking about, how did that change even at the lower rates that you're talking about, 4% instead of 6%? But how did the affordability of a mortgage change compared to, let's say, 2 years ago?
Are you saying with affordability?
Yeah, how affordable it is because of the higher costs of everything else going up, the affordability of paying this price for housing with this mortgage, how did that change compared to a couple of years ago?
Well, so I mean, compared to a couple of years ago, we had extremely low rates, so it's going to be going up. I think the relatively positive thing is okay, so it's kind of a double-barreled question because we're talking about mortgage and then on top this extra cost of living, right? So I'm going to kind of bifurcate both. So obviously they've gone up slightly, but bear in mind, if you look at roughly, the easiest way that I like to look at, I guess, affordability is proportion of income spent on kind of housing related. That can be rent, that can be mortgage. And many kind of expensive places we're getting up to, say, 45, 50. A lot of the time in the UK, things have been around sort of 35%, and that's kind of actually where it had been previously. So bear in mind that a lot of these guys are yet to roll on to these higher rates, and there's a huge amount of remo coming on this year. So one positive thing that we haven't actually talked about is there's actually 1.8 million mortgages this year up for remortgage. So the actual remortgage side this year will boom just because there's all these old mortgages kind of coming off. I mean, it'll be slightly more expensive, but bear in mind that due to the fact that the average house price in the UK is sitting just under sort of £300,000 compared to many other places which would be a lot more expensive than that, and the fact that their income level, so the amount of their income they spend on housing was actually relatively low compared to other people. Things are, I mean, it's definitely harder, don't get me wrong, but there's a lot more slack in there than people kind of give it credit for. They've got a lot more sort of ability to pay than, say, if you're sitting there, say, for example, in my home country like New Zealand, where the average house price is 1.4 million and you had a 2% mortgage, and then all of a sudden, and you are spending 50, 60% of your income on your mortgage, and the rate goes to 7, you've got enormous problems. So the UK, relatively speaking, is actually in a very strong position relative to other kind of first world countries. Hope that kind of roughly answered your question.
Anybody? 1 second.
Hi, thanks, Chris. Can you explain a bit the incentive scheme for the advisors? Do they are they neutral? So if you're a client, do you get the best mortgage, or do you get the one that gives the best incentive to the advisor?
So the fee is standardized by bank. So it's basically a 39 basis point fee that gets paid by the bank. So the advisors are all agnostic. If I write one from Barclays, Legal & General, Halifax, doesn't matter. So that's the important thing to understand. What they will do is they actually legally have to provide you, the buyer, me and my wife. They will actually have to provide you the best mortgage. So if we actually logged into Midas, they would obviously ask me a bunch of questions. How much do you earn? Equity, etc., etc., etc. Kind of go through the KYC platform. It's all within the platform. They can't use other platforms. It has to be within your MAB, advisor. And at that point in time, they'll say, right, we're going to look across the whole market and provide the best mortgage possible for you. And that could be anyone. So if you think about it from like a customer perspective, it's actually a really good deal. They're kind of doing the shopping for you, and then sometimes, it depends on by advisor, but you might have to pay a small fee, but really the fee is being paid by the bank. So that's kind of the thing to understand, is that it's a really good deal for the client. This is actually sort of really positive for the clients. And that 39 basis point fee, I've asked all the different providers in the market, it's kind of never changed, and it probably never will change. It's kind of the structure of how things work. So hopefully that answers the question.
Thank you very much for the presentation. I have one question regarding the competitors. How they compete, or what is the main competitive advantage versus, for example, Primis, which I think is his biggest competitor?
Yeah. So you're right. Primis is from LSL. That is the largest competitor. So I guess that we can look at it kind of from two different ways. In terms of MAB's obviously got much higher productivity per advisor. So if you actually want to go, and as I said before, because of the fact that they've got the best lead source and they've effectively got the best process, MAB has actually kind of got, they're capturing the top advisors. As we saw before, that MAB's been growing their advisors by about 20% per year. What actually happens is that they actually cut the bottom 20% of advisors each year for quality control. So gross, they're actually growing 40% per year, which is actually quite an important thing to understand, because of the fact that they want the top of the top of the top of the top. And to be honest, I've actually spoken to LSL quite a lot, and I've actually met them a number of times over time. And a lot of the time, the advisors they'll be picking up will be the guys that are kind of the offcuts of MAB, basically. And that's, I guess, the sort of the competitive advantage of these guys is the fact that they have just such a high, strong source of leads. So that's the kind of the important thing to think about is, I'm a 3 to 20 man team of financial advisors as franchisees. I could go to Primis and just earn less money because of the fact that there's kind of less lead sources, and I guess kind of not as good a process to actually kind of be able to run my business. Or if I'm keen to actually work hard, I can go to MAB, get a lot more leads, spend a lot more time on the phone, earn more money. So if I want to kind of go and win, that's basically where I want to go. So they have a very sort of selective list of adding people. So theoretically, they could have grown a lot quicker, but it's about quality control. Having the right top guys growing at a good rate anyway, but making sure that we get the product and the actual service as being quality. It's the same reason that McDonald's doesn't open 5,000 franchisees a year. They do it progressively and slowly. And that's the important thing to sort of understand, is actually the fact that, basically MAB just has a better process and more leads than LSL. And it shows the numbers. LSL is doing around £6,000 per advisor of EBIT. MAB's doing 12. So you have a number of different sources in terms of, so this is actually quite an important way to understand things, is that you'll have a number of different kind of online sources where there'll be, say, Money Supermarket or something like that. They've actually they've kind of had like a tie-up with them, where, for example, people will go on and be comparing different things, and then from there they'll actually kind of be feeding sources in. The other thing to understand as well is that there's what's called build to rent in the UK. So you have a number of different people who will be basically buying properties to then go and rent out to people as kind of investment properties. They'll have residential landlords, for example, who own a couple of properties. So same thing happens in New Zealand. My parents own a couple of these investment properties. And a lot of the time what you can do is you can actually go out and they'll actually have a close relationship with estate agents who are selling properties. Estate agent will talk to them and say, look, we think we can lease this at this. We think that the property price is this. You're looking at roughly sort of a net yield of this. You could get a mortgage for this. You've got a positive cost to carry. And so that's kind of a lot of the way that they'll do it is they'll go out and sort of work their book. They're kind of working with these individual investors and advisors and saying, right guys, okay, look, there's a property over here. They're kind of almost not a business advisor, but they're helping them kind of actually sort of, I guess, invest in these properties. So that's kind of like a really, really important game, because what many people don't really understand is that in the UK, for a lot of these things like estate agency or for mortgage advice, it's a very regional game, and it's actually a very sort of local game. So for example, if you look at the estate agents like Belvoir and TPFG, those are almost kind of little regional monopolies and things like that. And that's the important thing to understand, is they'll go and talk to the estate agents, or they'll go and talk to the investors and say, right, how can we go and sort of generate this business? Or they'll be getting leads fed to them, at which point they'll be kind of on the phone. So there's kind of two sources, and it depends on what kind of advisor you are. So you might have some guys who'll be phone guys, you might have some guys who'll be kind of, let's call them kind of go out and get business guys. That's the easy way to kind of think about it. So it's kind of roughly split. I don't have the exact split, but that's kind of my understanding of how they kind of generate it. Any other questions?
Anybody else? No? Thank you so much, Chris.
Thanks.